Hello friends, a very good day to all of you. Today I'm going to discuss the scope of business finance. In the last class, I had explained the approaches of financial management, and today I will discuss what can be the scope of business finance. So let's begin with the main scope of business finance. Following are the main scope of business finance, and the first scope is to estimate the financial requirements. Second scope of business finance is determining the capital structure. The third scope is the choice of sources of finance. Fourth is investment decision. Fifth is management of profits. Sixth scope is management of cash flow. And the last scope of business finance is implementation of financial controls. So these are the 7 scope of business finance that I'm going to discuss one by one in detail. So let's discuss the first scope of business finance, that is estimating the financial requirement. First job of any finance manager of an enterprise is to estimate the short-term and long-term financial requirement of his business. And for estimating its financial requirement, finance executive is required to prepare financial plan for present as well as future requirements. And apart from this, the finance required for procuring fixed assets as well as the working capital needs will also need to be ascertained. Means the finance manager is required firstly to prepare the financial plan, which depends upon its present financial requirement as well as future financial requirement. And after preparing financial plan, he is required to ascertain the requirement of procuring the fixed assets as well as the cash or the liquidity which is required to meet its day-to-day affair. Next thing under this, he is required to estimate the financial principle. Means these estimations is required to be based on certain financial principle, and these principles are in line with in such a way that the funds which are available with the firm should neither be inadequate nor excess. Means the capital which is required should neither be excessive, should neither be inadequate. If it is excess, then it will remain idle and it will act as a non-performing assets which is loss for any firm. And if firm do not have sufficient fund or due to inadequacy of the capital, he is not able to meet the financial requirement on time, and due to that shortage the company has to suffer loss. So in order to overcome this problem, the estimation should be based on sound financial principle. Now, the second scope of business finance is determining the capital structure. After estimating the financial requirements, the finance executive have to decide about the composition of capital, means what will be the structure of capital. If they had generated fund through different sources like through equity share or through preference share or through debentures, so what will be the proportion in which ratio they had formed a capital is to be decided here under determining the capital structure. So the finance executive is required to take decision on the quantum of funds which is needed and the type of securities through which the funds can be generated, and what will be the proportion of different securities is also decided here under the capital structure. Apart from this, he has to consider other sources also, other sources of owners capital and other sources of borrowed capital. In case if they want to generate capital, then they have to consider the other sources also, and it should be related with the short term or long term tenure for raising the fund. Apart from this, a decision regarding various sources of fund should also be linked with the cost of raising funds. For example, if the enterprise had generated fund through equity and debt, so what will be the cost of equity, what will be the cost of debt, that too is to be decided here under this determining the capital structure. So a decision about the kind of securities to be employed and the proportion in which these securities should be utilized is an important decision which affect the short term and long term planning of an enterprise, as well as they have to link it with the cost of raising fund. That cost may be the cost of equity share, maybe the cost of preference share, maybe the cost of debenture or the cost of retained earning. So after estimating the financial requirements of an enterprise, as well as after determining the capital structure, it is necessary to choose an appropriate sources of finance. And these sources through which the funds can be generated includes shareholders, debenture holders, banks, and other financial institutions, as well as public deposits, etc. So the purpose of these sources is to avail the funds required by the enterprise, and the finance executive is required to evaluate each sources so that he can select the best source, keeping in view the number of factors like the need, the purpose of the fund, what can be the objectives, how much cost is involved in generating the funds. So there are a number of factors that need to be taken care of while choosing the different sources of finance. And another most important thing that need to be taken care of, if the funds is generated or required for a short period of a time, then banks, public deposits, and financial institutions are the best source through which the funds can be generated if the company's requirement is to get the fund for a short duration. On the other hand, if company required funds for a longer period of a time, then the share capital and debenture would be a better option. So it mainly related with the choice of selecting the main best sources from the number of alternatives, which is to be done by the financial executives, keeping in mind the number of factors like the need, purpose, objective, and the cost associated to it, so that he can select the best source of finance.
The next scope of financial management is investment decision. When the funds have been procured, then a decision regarding the investment pattern has to be taken. So here, after the procurement of the fund, after the choosing the different sources of the fund, now the financial executive is required to take a decision regarding the pattern, how those fund is required to be invested. So here the selection of an investment pattern related to the use of funds is taken, and a decision will have to be taken as to which assets are to be purchased, and it is to be used in an intelligent manner. Means the funds raised are to be intelligently invested in various assets as per the requirement of an enterprise. So this will help in optimizing the return on an investment. And the utilization of long-term funds require a proper assessment of different alternative, and this is possible through capital budgeting and opportunity cost analysis technique. There are number of capital budgeting technique, NPV method or net present value method, ARR method, that is accounting rate of return method, then IRR, that is internal rate of return method, profitability index method, payback period method, and discounted payback period method. So there are a number of techniques that we will be discussing in our future sessions under capital budgeting. So these long-term projects can be identified, can be assessed through these techniques, that which project is more beneficial and which is least beneficial, and accordingly a priority is set to invest first in which project, and in which project next priority is to be given. Apart from this, the funds will have to be spent first on fixed assets, that is the purchase of fixed assets, and then an appropriate portion will be retained for the working capital to meet its day-to-day requirements. And in various categories of assets, a decision about the type of fixed or other assets will also be taken here. Like while selecting a plant and machinery, and even different categories of them may be available. So in which assets they have to invest first in order to purchase that assets, that decision is to be taken here. And while making capital expenditure, that is how they are going to invest capital in long term, and which project should be chosen first for the investment is is taken by the invested by the financial executive. And while spending on various assets, the number of principles were guided by the management. These principles is your safety, is your liquidity, and the profitability. So the management should not ignore the principle of safety, profitability, and liquidity, and a balance should stuck between these principles. And one may not like to invest on a project which may be risky, even though there may be more profit. So the project which is more risky should not be selected, and this decision will help the enterprise to sustain in a market for a longer period of a time.
The next scope of business finance is management of profits. The utilization of surplus or earnings is also an important factor in financial management. Means how you are managing the earnings or the profit which is earned by a company, how that is to be managed is another factor. And this is essential because if a company want to expand their business or want to diversify the plans of the enterprise, then there is a need to manage the profits. So a certain amount out of total profit may be kept as reserve voluntarily, and a portion of surplus may be distributed among the ordinary shareholder or preference shareholder, and yet another proportion may be reinvested. So the finance executive must take into consideration the merits and demerits of alternative schemes of utilizing the funds generated from the enterprise own earning. So the part of profit can be distributed among shareholder or preference shareholder, which is known as dividend, and a certain proportion of profit is to be kept and reinvested in the business is termed as retained earning. So the management of this profit is also essential here by the finance executive for attaining the benefit in the future. The next scope is the cash flow management or the management of cash flow. It is another important task of finance executive, how he is going to manage the cash flow of an enterprise. So for this, he has to assess the various cash requirements at different times and then make arrangement for cash needed. So what are the requirement in different time period by an enterprise, and how he is going to make arrangement for the cash required is taken care of by the finance executive. In an organization, cash may be required to make payments to creditors. Cash may be required for the purchase of materials. It may be raw materials. Cash may be required to meet the wage bills, or it may be required to meet everyday expenses. So to meet all such requirements, there is a need of finance executive to estimate how much cash is required and how the required cash is to be managed so that the working should not stop. So the cash management should be such that neither there is shortage of it nor it is inadequate or surplus. And any shortage of cash, if it will occur, then it damage the credit worthiness of the firm. And the idle cash with the enterprise, if there is an excess cash is available, then it will not properly utilized and it will act as a non-performing assets. So in order to know the cash requirements during different periods, the management should arrange the preparation of cash flow statement in advance so that he will get an idea of present cash requirement by an enterprise. Now, the last scope of business finance is implementation of financial control. So an efficient system of financial management needs the use of various control of devices, and there are number of financial control devices that can generally be adopted within an enterprise. That is related to return on investment, that may be related to budgetary control, that may be related to cost control, or break-even analysis, or ratio analysis. So these are some of the techniques which can be generally adopted by finance executive for controlling the financial activities. And these techniques also help the finance manager to evaluate the performance in different areas, and it will help him to take corrective actions whenever needed to overcome certain problems. So under this, implementation of financial control is possible with the help of financial control devices. It may be return on investment, it may be budgetary control, it may be cost control, break-even analysis, or it may be ratio analysis. So that's all for today. Thank you everyone. Have a nice day.